Hey, it's Chris here. So I have been role-playing this video for a few hours now, and it's just time to fish or cut bait, right? So another article in the Wall Street Journal that's getting a lot of attention that I think is quite timely and super interesting. So let me show you what it is here. And that is Americans chasing high interest rates risk falling into a cash trap. So I thought to help address this, I'd help you define what is the cash trap, the pros and cons of trying to avoid it, a strategic approach to take, and how much cash should you have anyway. So let's sort of tackle it in that approach. So what is the cash trap? Well, it's essentially not putting your cash into investments with fixed rates and therefore potentially missing out on returns in a few years. So for example, most money market funds, I think you'd agree, recording this June 27th, 2024, are in the low 5% range. So here's 5.2 on the chart, and I'm just taking that simply because it's on the chart. Let me get my pen. If you know me, I love marking these things up. So here's 5.2%, right? And let's just say, again, let's just agree that money markets are paying 5.2% right now. They may or may not be. I think I'm close, but just go with me here, right? So this is the U.S. Treasury yield curve, and it's showing you how much you earn for different investment timeframes. So again, cash 5.2. Here's 2-year treasuries. Let's call that 4.7. 5 years, call that 4.3. This is interesting. 5, 7, and 10 can all get you 4.3% now. So why would you sell an investment? Why would you sell a money market fund, not use a money market fund at 5.2 and invest at 4.3? I mean, 0.9 less. Why would you take almost 1% less? And the argument would be that at some point, this money market rate will cease to be at 5.2. And if money market rates come down as they have in the past during periods of, I'm not going to say high interest rates, but higher interest rates than we've seen for a while. This is get rid of those drawings. This is the federal funds rate. So here's a better picture. I think even this article even has the federal funds rate. Here it is. So here's the federal funds rate. We are here. May of 24, we're in June, but this is through May, so great. But everyone knows, look, money market funds have just spiked in the past few years. And we had a very long stretch of time, as most of you can recall, and went through from 2010 to almost 2020. Here showing 2016. There's a little bit of a bump there. But for a long period of time, we had very little returns in money markets, and now here we have returns. So the risk is that you didn't lock in your rates from here to here, and your money market fund went down and up a little bit, and back down and up. And so the average of all these years in a money market is less than, say, had it been available, had you bought a 5-year bond here in the late 20s, 2007 or 8, say you bought a 10-year bond and you made it to 2017, you'd had 5% that whole time instead of less, right? So this is sort of a good graphic of the cash trap, and this could potentially happen again. But the difficulty is right now. Let's see. So 2007. So this is a yield curve now. What was the yield curve in, call it June of 07? Yeah, I mean, you could have gotten, it's a little bit different here. You could have gotten 5%. Well, you could have gotten 5% for 5 years but we went 10 years. You could have gotten, 5.25% for 10 years in June of 07. But right now, and that was higher than the money market then. So it was sort of not a no-brainer trade, but it made it a little bit easier to tolerate. Why earn, 4% in a money market or 5% in a money market when you can get 5% for 10 years or 5.25% for 10 years in a government bond. So a little bit easier when the trade is, call it at parity, or it's a higher rate of return. But this is such a tough sell, honestly, right now. I mean, why move out of a money market rate, take 1% less, and take 1% less, tie up your money, I mean, well, the reason for it again is just to bridge that gap. You can earn money if rates go down. You're going to drop from the current fives down to whatever they go to. I mean, rates could drop to 4, 3, 2. I don't know that to go back to near zero again, but rates could be less, and so it's just total rate of return over your holding period. So I think that dovetails into the pros and cons of trying to avoid it. The pro of trying to avoid it is that you can fix, where's this rate chart? Let's see here. You can fix, monies essentially now. I guess our yield curve chart's really the best one to do. Can I just get rid of just that time series? No, we'll just reset it. So, really the pro of trying to avoid it is you can lock in 5 to 10 year bonds at 4.3%. And if you have monies that you're going to spend within the next 10 years, this may not be a bad approach. If you have monies that are designed to be used in greater than a 10-year period, I mean, I would fully invest those funds. So a pro and con of trying to avoid it. The con of trying to avoid it is that you take liquid funds and you lock them in at a lower rate, and you're tying up your money for a longer time period than immediate, and you're getting a lesser rate of return. So that's the con of trying to avoid it. And also, if rates drop sooner than expected, more than expected, rates don't hold up, you're going to miss out on rates of return in the future. And the pro to just holding cash right now is security, predictability, on-demand money. Very tough to convince someone, I'd say, with who needs money within 5 years to do anything with their cash, and certainly 3 years. But I'm telling you, beyond 5 to 10 is, I call it a gray area. Beyond 10 years, I would greenlight you to invest in bonds or stocks just based upon historical market returns. And so a strategic approach to handling this would be what we call a bond ladder. And that would be, let's say you break your cash portfolio into 20%. You would keep 20% at the money market fund, maybe 20%. Let's just do it this way. 20% into a 3-year, 5-year, 7, and 10 years. So 20, 40, 60, 80. Now 100% of your current cash position is invested at different time frames. And it helps, if you're consistent, the goal of doing this is it helps take the guesswork out of reinvesting. So you spend money. If it's money you're going to spend, I'm going to have to assume this is money you're going to spend. So you keep 20% liquid and you spend that for the first 3 years. Then this money comes in and you spend it. Until this money comes in, you spend it. Till this money comes in, you spend it. Now you're out of your cash. Right? Now let's assume you have other investments that you've invested for this 10-year period, and now you'll start to use those monies. So that's a great dollar sign. And now you'll start to use those monies beyond the 10-year period. So this sort of takes out interest rate risk a little bit, because I'm going to assume that this cash trap, I guess I keep defining it in my head. The cash trap is holding cash for more than 10 years, in my opinion. Again, 5 years is a gray, 5 to 10 is a gray area. Below 5 years is green light to hold cash. But the concern is that for more than 10 years, holding cash might be a bad idea. Just over that amount of time, inflation, bonds could do better, stocks could do better. You have a higher probability of success in stocks and bonds than you do in a money market for a 10-year period and beyond. Even 5-year periods and beyond, you have a better chance of success with stocks and bonds. However, stocks and bonds do have lost money over 5-year periods. Stocks have lost money over 10-year periods. Research I've seen indicates bonds have never lost money as far as principal. The bond index over a 10-year period, but you may lose purchasing power. But I'll tell you, let me switch this back here. I don't know. No one's remorseful. No one. Well, the remorse. I have a phrase. The remorse of loss is greater than the reward of gain. So, losing money hurts more than not making money. I tell you, that's what I've seen. And over time, you'll probably forgive yourself more for losing to inflation than you would forgive yourself for losing principal. I just think that would come to fruition for most people. So, how much cash should one hold? Just moving on to the fourth bullet point, anywhere from 0% to what I would say, not 100%, unless you're going to spend all of your money over the next 10 years. I suggest to folks that the more conservative you are, the more cash you should have. If you want 10 years of cash, say you spend $100,000 a year, you need $1 million of cash to feel comfortable so that you'll have generally spending money for the next 10 years. Like don't rebut with inflation at this point. Let's just go straight line here. For the next 10 years, you'll have money to take out. You'll have $100,000 to take out of your account and to spend. Maybe 5 years of cash is more tolerable. You'll have 5 years of money. If you have 5 years of money in cash or bonds, and then you let the rest of your money go into a stock market portfolio, that rest of your money has, I think, over 5 years, an 80% chance of increasing and a 90% chance of increasing over 10 years. Not to say they haven't lost money over 5 and 10 years. They have, but your chances of success are a lot greater. So just by having cash, if having cash gives you confidence to not sell or be concerned about the growth portion of your portfolio, then that would also dictate the amount of cash for you to have. But I really do suggest that people consider not cash as a percent of the portfolio, but as far as years of spending. Do you need 1 year of money in cash? Do you need 3 years of money in cash? I absolutely pay no attention to that six months of spending money in cash as like the financial planning playbook. I'm just not into that. And if you're younger, you should just be growth, invest. You have 6 months in cash. That money will never grow, and the opportunity cost of that. And yeah, someone's going to have an emergency and need money. However, I just think you have a better chance of success just by investing your money in growth from day one as a younger person. So let's just to cross that off of that 6 months of spending money in cash that all these financial planners say, or pros. I really don't follow that school of thought. What I ask people to do is as they have more money or as they approach retirement or to where they foresee needing their monies, just years of monies in cash and conservative investments such that you can let the other portion of your portfolio continue untouched. Just let it ride. So when it comes to how much cash, again, the more conservative you are, the more cash, obviously, but I would ask you to think not in terms of percent of your portfolio, but in terms of years of spending money. And again, so you spend $100,000 a year, maybe 3 years, $300,000 of cash or short-term, highly predictable investments, maybe 5 years of money. If you're more conservative, 10. If you're super conservative, maybe 1 year or 2 year. If you're not if you're more aggressive. So that's it for this. I really thought it was an interesting article on this, what they're calling a cash trap. and how the pros are just encouraging people to not fall into it. But I don't think the trap really starts until a 5-year period. Definitely a 10-year period in my mind. Potentially 5 to 10 years is a cash trap, but for the next 1 to 3, I simply don't see a trap per se. Well, there might be ultimately, but I think you'll forgive yourself if for the next 3 years you haven't invested and rates go down. But for the if rates go down soon and you haven't moved out, and then now you're holding a low rate of return, a 1% rate of return investment for too long, I think you'll even start to notice that you should have done something here today, June of 2024. So that's it. Hope you find this helpful. See you back here at some point.